there. And we're going to get some more on the market's reaction. Let's go ahead and bring in Jim Bianco of Bianco Research. Jim, thank you so much for being here. You know, I think it's very interesting that we had you on just about a year ago. I think it was about January 3rd, so give or take a couple days. And at the time, we were asking you about what your take was for the 10-year Treasury. I think you said about 5.5%. And you think that's kind of where we're going to stick going forward still?
Yeah. You remember that in October of 2023, the 10-year Treasury hit 5%. And I thought at the time a year ago that we would probably make a new high somewhere between 5 and 5.5. Now, we got the 4 3/4 back in April, and we got very close to it last week. I still think we'll probably sneak out a new high, above 5%. And we're closing the year at 456, so that's not that bold a call anymore. It's only about 40 basis points away, so it doesn't have to redefine the world. But I do think that the trend in interest rates is still going to stay higher, at least for the first half of the year.
And then how is your assumption playing out with what the Fed will do? Because it hasn't been as correlated with the 10-year yield as you might have assumed, at least recently.
That's right. You've seen that the 10-year yield has gone up almost 1% while the Fed has been cutting rates. The last 60-odd years, that's only happened one other time, and that was 1981, when the Volcker Fed cut off of 20% and the bond market didn't like it. So this has been quite a move to see that rates have been going up while the Fed's been cutting. Why? I think the market's rejecting the rate cuts. It's saying we don't need them. They're not necessary. And if you're going to continue to cut rates, you're just going to raise inflation expectations. And that's why, as the Fed continues to cut and talks about cutting in 25, the bond market just, reacts to it badly. I think if the Fed wants to see yields down, maybe they should stop cutting.
Yeah, I'm with you on that, Jim, and your work has been extraordinary here. And here we are, somewhere between 4.5% and 4.6%. I don't think a lot of people thought that was possible. Where does the market start to care? Because it's seemingly caring now over the last week or so, but where does it really sort of peak up its ears and say, hey, this is a problem?
Oh, I think it's starting to care now, like you said. And I think, if it gets to 5 or above 5, it will really start to care. And why will the market care? It gets back to an earlier conversation you guys were having a few minutes ago. The valuations in the market are very high. That's not a timing tool. The market continues to go higher, but it is an expectations tool. If you have a high valuation market, you should have lower expected returns into the future. And if you look at the work by Bob Shiller and JP Morgan and some others, the valuations of the market suggest that you should get about a 5 or 6% return over the next couple of years in the stock market. I know it's not the 20% we're used to, but look at bond yields. They're at 5%. And if the bond market is going to offer you the same thing that the stock market could offer you with a lot less volatility, that's a problem for the stock market because it's just a more volatile way of getting the same thing for the bond market is going to offer.
Jim, when you look at your thesis in all of our businesses collectively, we have to decide what could make it go wrong. So in your thesis, what are those ideas that might change the end goal for the 10-year for you? What could you get wrong, or what could the market get right?
Yeah, so, the big one that you can get wrong would be a recession. It would be a slowdown in the economy. Now, I know that, people have said on and off for the next several years that the economy's slowing, we're going to go into recession, but the data is not showing that right now. But if somehow something happens, an event that scares the market and it turns the trajectory of the economy south, then it'll turn the trajectory of interest rates south. But right now, the reason that they're staying up and going higher is at the top line, the economy is not showing any signs of slowing down. It's part of the reason why every market has been, every risk market, whether it's stocks, it's corporates, it's crypto, has been rallying this year because there isn't a problem at the top line.
Jim, thank you so much for joining us here tonight. Happy New Year to you.
Happy New Year to you.
Bonawyn, what do you make of some